Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Stuart Katz, Chief Investment Officer at Robertson Wealth Management, to discuss what the bigger risk for investors today is: interest rate risk or recession risk. An excellent question. But before we get to that, Stuart, welcome back to the show. I want to talk about recent market action with you. What do you think about the market rally that we've seen? We've actually been able to string together a few green days here.
Yes, we have, Jill. And thank you for the invitation to join you again. There are several recent developments that I think help explain the market optimism that we've experienced and witnessed. It includes certainly a lower CPI print, an encouraging PPI print, coupled with DC gridlock and optimism that China's reopening and Russia's withdrawing. However, we're investing for the long term, and we believe that inflation is going to be more persistent than history would suggest. And we believe the go forward requires investors to recognize there's a new normal, so to speak, one where it's not low rates and low inflation, but in fact, structural forces which are going to lead to more persistent inflation and therefore higher rates for longer. And that's going to impact costs of capital. That's going to challenge multiple expansion, and people need to be, saddled up in their portfolio for that kind of world.
What's the bigger risk for investors today then? Is it interest rate risk or is it recession risk?
It's an excellent question. And for us, we're tracking various sort of key metrics, but one that we find interesting is the MOVE index. And that measures interest rate volatility. And we can see that since the great financial crisis and before the COVID pandemic, volatility was about 25% lower than it was pre-great financial crisis. That was a wonderful Goldilocks time for the markets and investing. And now that interest rates have been moving up so quickly, thanks to our central banks and our central bank and many others, you're seeing positive correlation in stocks and bonds, right? IG credit and the S&P down both mid-teens is really a wild kind of experience, and one we haven't seen in many, many decades. And so the pivot now, we think, is a move more towards recession risk as opposed to just increasing concerns about interest rate risk. And the inversion curves that you're seeing across the yield curves are very strong indicators that the recession is coming, and people need to now start underwriting a slowdown in earnings.
What are the implications for investors with the traditional so-called 60-40 portfolio?
Well, the dramatic rise in the 2-year within a year, going from 10 basis points to over 400 basis points is absolutely spectacular, and that has just caused carnage in the traditional 60-40 portfolio for the reasons we were just discussing in regards to the positive correlation between stocks and bonds. But with this increasing recession risk that we're discussing, the implication for 23, we think, is slowing corporate earnings, and the markets are struggling through price discovery to figure out, okay, the numerator in the P has come down, but now the denominator in the E needs to come down. And as a result, we're constructing our portfolios with strong defensive characteristics in healthcare, inflationary hedging through energy, and still maintaining certain very tactical and strategic allocations to tech companies where there's a real track record of pricing power and superior cash flow generation. That's the kind of thing we want in our portfolios, and ballast in munis. We think there's a tremendous opportunity right now to earn tax equivalent yields of 6-7% in the short to medium term duration, and that's what you want in your portfolio.
Stuart, are there any alternative strategies that you're evaluating?
100%. Traditional long-only equities and fixed income, we think, will continue to struggle and find its grounding. And therefore, what we're focusing on currently is distressed credit, attributes where you can be senior in the capital structure, have hard assets beneath you, real covenants. These are the attractive features in a portfolio to really find more risk reward that's better priced than the traditional, if you would, public equities and fixed income.
All right. Appreciate the insight as always, Stuart. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.